What if the biggest risk to SpaceX investors is not competition, regulation, or a failed rocket launch? What if the real risk is that many people are valuing the company based on the wrong business? SpaceX is one of the world's most valuable private companies, and investors continue competing for access to shares. Yet beneath the excitement sit assumptions that could dramatically influence how much the company is actually worth. If those assumptions prove wrong, the consequences could be significant. Rockets are the product everyone sees. Falcon 9 launches dominate headlines. Reusable boosters land with remarkable precision. Every successful mission reinforces the belief that SpaceX is years ahead of rivals. The launch business is impressive, but investors often assume launch dominance automatically creates unlimited economic value. History suggests otherwise. Even if SpaceX remains the leading launch provider, there is a practical limit to how many payloads need to reach orbit each year. Demand can grow, but it is not infinite. As launch capacity expands, prices can decline. Lower prices benefit customers, but not always margins. That distinction matters because valuation is driven by future profits, not engineering achievements. Investors celebrating every successful launch may be watching the wrong scoreboard. The business that may ultimately determine SpaceX's value is Starlink. Starlink is frequently described as satellite internet, but that description understates what investors are evaluating. A rocket launch produces revenue once. A broadband customer can generate revenue every month for years. One resembles a project business. The other resembles infrastructure. Infrastructure businesses often become more valuable than the technologies that enabled them. If Starlink succeeds at global scale, SpaceX starts looking less like an aerospace company and more like a communications platform with recurring revenue. Markets typically reward recurring revenue with higher valuations because it is viewed as more predictable. Satellites do not last forever. Networks require maintenance. Hardware must be replaced. Capacity must expand continuously. The constellation is not a one-time investment. It is an ongoing investment. Subscriber growth alone does not determine success. What matters is whether the economics remain attractive after replacement costs, operating expenses, customer acquisition, and upgrades. Now consider government dependence. SpaceX has benefited enormously from government relationships. NASA contracts helped validate the company. Defense contracts expanded revenue opportunities. National security missions increased strategic importance. These partnerships created substantial advantages, but they also introduce a risk that receives little attention: dependence. Political priorities change, budgets change, procurement strategies change, regulatory environments change. The key question is not whether governments need SpaceX. The key question is how much future growth depends on continued political support. Those are different questions, and the answer matters because valuation models often assume continuity where history repeatedly delivers change. Many investors believe SpaceX has already won. That mindset can be dangerous because expectations matter. Competition does not need to destroy SpaceX to affect valuation. It only needs to slow growth. When investors value companies based on ambitious outcomes, even small changes in growth assumptions can create large changes in present value. A company expected to grow at 30% annually is valued very differently from one expected to grow at 20%. The difference sounds modest. The valuation impact often is not. Future competitors may emerge from launch providers, satellite networks, or entirely different technologies. The point is not predicting who wins. The point is understanding that extraordinary expectations leave little room for disappointment. Whenever investors discuss SpaceX, the conversation eventually turns to one question: how much is it worth? A better question is how much future success is already reflected in the current valuation. Consider everything investors may be assuming: continued launch dominance, rapid Starlink expansion, successful next-generation vehicles, increasing government business, global connectivity growth, and future industries that do not yet exist. None of these outcomes are impossible. The challenge is that many valuation models quietly assume most of them occur simultaneously. History suggests reality is rarely that cooperative. Now consider Mars. Mars is central to SpaceX's mission. It inspires employees, attracts talent, generates fascination, and differentiates the company from almost every other business. Yet investors must separate mission value from shareholder value. A future Mars settlement could create extraordinary opportunities. It could also require extraordinary investment. The timeline, economics, and regulatory framework remain uncertain. Mars may become one of the most valuable strategic assets in history, or one of the most expensive ambitions ever pursued by a private company, possibly both. That is why investors should be careful when incorporating Mars into valuation assumptions. The dream creates value. Funding the dream consumes resources. Finally, consider regulation. SpaceX operates in industries deeply connected to governments and international authorities. Spectrum rights, international approvals, national security concerns, orbital congestion, and environmental issues all matter. The larger SpaceX becomes, the greater the likelihood that regulatory decisions influence growth. Many investors model technology. Fewer model regulatory friction. Regulatory outcomes can directly affect expansion plans, margins, and future cash flows. Regulation is not merely a legal issue, it is a valuation issue. So where does all of this leave investors? SpaceX may eventually become one of the most valuable companies in history. However, the future value of the business may depend far less on spectacular launches than many people assume. It may depend on recurring revenue, pricing power, customer retention, network economics, and factors that rarely make headlines. The biggest mistake investors can make is treating SpaceX like a simple story. SpaceX operates at the intersection of aerospace, communications, infrastructure, defense, and technology. That combination creates extraordinary opportunities, while also creating risks that are easy to overlook when excitement dominates the conversation. The investors who understand SpaceX best may not be the ones celebrating every launch. They may be the ones asking questions about margins, incentives, competition, regulation, and capital allocation. Because the most important thing SpaceX investors do not know yet is not whether the company can change the world. It is which part of the business will create the most value. That answer will likely shape returns far more than launches alone ever.